Welcome to Regulatory Ramblings Briefs. Our guest today is Sijuade Animashaun, a third-year PhD student at the HKU Faculty of Law. He's written a paper on the Great Crypto Crisis, the Prudential regulation of systemically important crypto conglomerates. Harkens back to the lessons learned after the 2008 financial crisis and the designation of some financial institutions as being globally systemically important institutions whose peril could take down the international financial system. So I will turn over to Siju. Siju, thank you for joining us.
Thank you, Ajay, for having me.
My pleasure.
Yes.
So, just quick intros. Tell us a little bit about yourself. Your research interests and what brought you to this topic.
So that's good. So I'm Sijuade Animashaun. My PhD is on the application of fintech to payment services and, of course, cryptocurrencies to find it for broader policy implementations of financial inclusion. But recently I see it overlapping with how it affects financial regulations and other key policy implementations too.
Yeah, no, it's a seamless web. It's all connected, and I think that's the central theme of your paper. That there's an increasing interdependency between participants in the crypto ecosystem, much like there is in traditional financial systems. The nature of the looming crisis, you say, in the crypto ecosystem is starting to look like the Lehman crisis.
Yes.
The collapse in lending firms is affecting blockchain.com and other crypto exchanges.
Yes,
that's a heavy charge.
It's a dramatic transition in what we're seeing now. Because before now, when you think of the white paper on the Bitcoin, you hear things like disintermediation, decentralization, with total depart from what we have in traditional financial systems. But now, increasingly, you see that the majority of activities that you're seeing in the crypto ecosystem is being propelled by the crypto conglomerates. That's exchanges, hedge funds. They are having individual giant crypto firms providing multiple financial functions in a systemic way across multiple borders and with systemic implications, within the crypto ecosystem. But as you would notice recently, that there are increasing activities in crypto assets, the global stablecoin arrangements with high potentials of even cross-pollinating into the traditional financial system. So, yes. So,
no, it's interesting that you say that because, once upon a time, we think an analogy to what you're saying is once upon a time in the world of futures, it was all commodities. And then you think back to how creative people at the Chicago Board of Trade in the 70s realized if you bundle together a bunch of currencies, Forex a certain way, you could have a futures market in that. So conceivably, we're seeing the instrument of cryptocurrencies being used for purposes beyond what was originally envisioned. That people are pushing the limits of finance to the nth degree.
It's phenomenal, and the resilience of the ecosystem is quite innovative, and the resilience is just phenomenal because you see there was a recent survey by BACT that said in the US alone, the amount of...
That was in December, right?
Yes. The survey suggests that the people that are even interested in purchasing crypto or going into the ecosystem stood at 89%. That was pre-FTX crisis. And even after the FTX crisis, the number only dropped by 7%. So it's 82% now. It suggests a very phenomenal resilience. The ongoing crypto winter crisis has shown that even despite the increasing interdependencies, we are seeing concentration risks between the crypto exchanges, the confined firms, all concentrating in the hedge fund. That was the 3AC before its collapse. And this tells you that the global network operating within the crypto ecosystem allows for new, what I call associational risks. We're finding different terminologies to construe this now. We have things like crypto runs that are functioning like traditional runs. We have the investors losing confidence in crypto hedge funds and trying to massively liquidate their assets. And this is having beyond recognition impact within the crypto ecosystem. But my concern is it is easy for the regulators to insulate the traditional financial systems from the crypto ecosystems now. But with the increasing established interlinkages, what will be the consequence of a potential great crypto crisis that can have a spillover effect from the crypto ecosystem into the traditional the financial system? That is actually the crux of my paper at this time.
To pick up on that, I think you pointed out to me recently that whatever the focus on crypto regulations, they need to first take care of the intermediaries. And they're important because if you look at the FSB's report from last year, intermediaries and exchanges are the oxygen tanks of crypto ecosystems, because most transactions in this space are processed by exchanges. As much as people try to insulate between traditional systems, finance, and crypto,
absolutely,
there's more linkages between traditional finance and crypto, you say, and that therefore regulations need to be crafted accordingly to mitigate for crypto-related systemic risk.
Yes. So when you look at the present arrangements on the global stable coins right now and crypto assets, you see there's a higher volume of investment in it. You're seeing strong interactions between the global crypto exchanges as well as traditional providers. But the issue there is the regulatory system that we have at this time. There are very highly commendable approaches by international regulatory bodies. We have the IOSCO CPMI, we have the BIS working extensively, we have the FSB, and there are other international financial regulators that are functioning right now. But more to the point is the approach of the national regulators. Now, like we see with the last global financial crisis, giving a microprudential approach or a national jurisdictional approach to a cross-border or a global financial activity contains a lot of regulatory arbitrage and gaps.
Absolutely.
Yes, because there are issues of extraterritoriality. The most recent FSB report was even identifying some of these concerns, that how do you apply national jurisdictional policies to global issues? So if this continues at this age, we see that the best thing that regulators would have to do is to follow up the trend, to identify the emerging risks, that it has a systemic risk, so that it doesn't cross-pollinate from the crypto ecosystem to the traditional financial systems.
That's a term you use a lot, cross-pollinate, but I mean, is it, given the globalized, interconnected world we're in, is it necessarily possible then to necessarily ring fence and insulate against all those external risks? Some of them are bound to, as we're seeing with the pandemic, and we saw this with even the global financial crisis. By February people think, oh, China was doing well that time, that protected Hong Kong to a great extent. It did. But by February of 2009, the global financial crisis had caught up in Hong Kong. In a serious way.
I think you have a good point there, because when you look at even the suggestions of the BCBS now for for prudential regulations of crypto assets exposures that global banks or traditional financial institutions have globally, you see there is this idea of, well, I wouldn't want to call it ring fencing, but there's a restrictive approach to crypto assets, crypto ecosystems. So telling them the capital adequacy measures that would apply to both backed as well as unbacked cryptocurrency assets and their dealings with it. Now, to what extent will this be implementable? It would rely extensively on the national approach of the member states to the BCBS. But we have seen, if you check places like Central African Republic, El Salvador, they're even making crypto their legal tender, and with other countries even giving more recognition to crypto-related activities. This, to a large extent, will keep increasing the arbitrage, because the approach that individual policy implementation takes to the global issues that we have will go a long way in determining the effectiveness and the efficiency of regulatory systems to the crypto ecosystem.
I mean, clearly global rules are needed because you wouldn't
Yes.
want. I mean, you recall that once upon a time in the post-war era, when Britain was looking for a role for itself post-Suez,
Yes, okay.
and they decided to focus on financial services, and so they created the London Eurodollar market, and that the claim was deposits held in UK banks are fall under our jurisdiction, but the Eurodollar market, we exercise no jurisdiction over that because jurisdiction lies elsewhere. Didn't matter, just somewhere elsewhere. I hope they don't resort to creating contorted legal fictions now in terms of deciding how to regulate crypto. But you make an astute observation when you point out the need to designate giant crypto intermediaries, the crypto conglomerates that operate in multiple jurisdictions, much like SIFIs post-2008, strategically important financial institutions. You call them strategically important crypto intermediaries.
Yes.
There's a need for more regulatory harmonization, cross-border regulation in crypto because different countries regulate crypto differently and the gaps are causing problems. Knowledge sharing is critical. But again, then you have turf war, regulatory turf wars. You see that in this region, and I don't see why you would expect differently in Europe. I mean, I remember this was David Cameron's last year in office. This was either 2015 or 2016, and he was lecturing the Europeans on tax evasion and what have you. But this is the bread and butter of the British Crown-dependent overseas territories. And this was against the backdrop of FATCA and the OECD's standard that they were putting out. And again, people point to people point to the need for a universal beneficial ownership register, perhaps under the aegis of the UN. But the very countries that benefit from the status quo would have their interest impaired by such a scheme. So you see the clash of national interests.
You have a strong point there. I think right now that there is a need for a global approach, coordinated supervision is beyond argument right now. So like you mentioned, it's still a fast developing area. People are coming up with different strategies on how to effectively manage the gaps and the risks, cross-pollinations that we are seeing. In my paper, I have proposed that there should be a form of structural regulations. If there are structural regulations in the intermediary-based levels of approach to this, the most desirable that I think will be directing it at the critical market providers. That's the key actors in the crypto ecosystem at this time, which are the crypto conglomerates. There are policies that are dealing with AML, CFT. We have others on prudential regulations. But if these are directed to the critical infrastructural, crypto market infrastructures, as well as the critical providers within the crypto ecosystem, I think it will provide a very strong basis for gathering of requisite information or data for more nimble and innovative strategic implementations globally.
What I liked about your paper is you don't shy away from this. You're very forthright about the need to target primary providers through structural regulation of intermediaries because of that strong connection between the exchanges. And I think you also point out whether or not regulators take the steps you advocate for, the structural regulation of crypto intermediaries, namely the business, will continue to grow. And as I think we've discussed, what you're calling for really is preemptive regulation, whereas the traditional stay ahead of the crisis, perhaps. The traditional pattern has always been technology develops, commercial activity ensues,
Yes.
a wild west or gray areas
Yes,
emerge.
for the time.
People get burned, or there's uncertainty that makes people uncomfortable.
Yes.
Then legislatures step in
Yes.
to craft rules and regs.
Yes.
I mean, you saw shades of this pre 9/11. There was not that much inclination to take action on money laundering in the U.S. other than Senator Levin, former Senator Levin, saying that on it was in the congressional record, the notes. But when the event happens, then everyone is shocked into action. Everyone is galvanized.
Yes.
Do you fear then that it'll take a collapse for them to implement what you're suggesting?
I think at this time that there is a bubble to burst in the crypto ecosystem has happened severally. If you check the events in the ongoing crypto winter that started since the early 2022 with the collapse of the sister tokens, that's Luna and Terra USD, transferring risks to 3AC, a major provider in the crypto ecosystem. It's not only caused the forced liquidation of 3AC, but has also affected all the crypto enterprise and firms that have heavily concentrated their stake and revenues in 3AC. We have Voyage Digital, we have Celsius, Vault, just to name some of it, BlockFi. And well, let's bring it closer. You see, there is another one that is happening since the collapse of FTX. Now we have this associational risk on crypto runs. Binance is barely trying to survive now, with some even projecting that it's soon to burn too. So I think,
I've heard those.
Yes, but I think, like you mentioned, the crypto system is still largely in a closed loop ecosystem now. So the demographics, their failures, the implications of it, we hear it in billions and billions, but it's still within the crypto ecosystem, but with the strong interlinkages.
That's the thing, though. Okay,
yes.
People are missing strong interlinkages because journalists like to sensationalize because they need hot cover, story content to lead with and to draw eyeballs and to get clicks. So the headlines tend to be sensational. Big numbers get attention.
Yes.
People are seeing the big numbers, but because, as you say, it's contained within the crypto ecosystem, it's accredited investors, it's big money people, it's people with deep pockets.
Yes.
The average man on the street, Joe Q Public, is not, Mrs. Lamb, to the best of my knowledge, being a fictional Hong Kong housewife.
Yes.
That type of person, that type of archetype, is not going into crypto in a big way.
Yes.
Therefore, people don't care. They don't feel it.
Yeah.
It seems to me then that a bad event, a Lehman-esque moment, needs to occur for people to appreciate the linkages between crypto and mainstream banking and finance.
Yes, I
because right now it's seen as it's still seen as a fringe.
That's true, because if you don't feel the impact of the crashes, the collapses in the real economy, they must as well turn a blind eye to it. Like, as far as the conventional financial system is insulated from this niche environment, then we are good to go. But that increasingly we see that is not a very sustainable approach long term. Because as I identified in my paper on the associational risks, when you see issues of consumer panics, now it's not justified by the stability of the associated firms or institutions to these failing crypto mega players. It is just a word, like from maybe journalists saying, oh, these crypto mega giants are failing, and these are the list of maybe associated firms or exposed intermediaries. And you just see the consumers in those other associated intermediaries just start to panic. So I think this even underscores what we have on the context of
consumers inducing intermediaries to panic.
No, consumers are panicking in other associated intermediaries is what I'm saying. Yes. Okay. So you see the issues with the Voyage Digital. It wasn't, I wouldn't speak in absolute terms, but as much as the exposures to 3AC played a critical role, but bank runs are fundamental too. And most times bank runs, excuse my language, I don't think are fantastically logical.
Yeah.
So you just have one person suggesting to others that please withdraw your money, and we can imagine how that played out in FTX that led to its collapse. And now even Binance is facing a very tough time trying to reassure consumers, their customers and investors that their stability is up and they're good to go. But once the panic starts, how do you curtail this?
I wanted to ask you about that. So,
Yes.
in your view, a collapse of one entity
Yes.
that's poorly run can even impact the confidence of another in the same marketplace that's still well run.
Yes. Yes. Because in the very traditional sense, when you think of exposures leading to contagion risks, you would assume that is the exposure that leads to maybe a liquidity crisis or a credit crisis from failures and defaults in financial obligations. We see some of that manifesting when 3AC happened. But for some other firms, you also identify that it was we call it the crypto runs now. The crypto runs from the associational risks emerging in the crypto ecosystem that really killed them, because they would have been able to contain the losses from the exposures to 3AC, but they couldn't keep their doors open because of the liquidity crisis they were having.
At that point, it was overwhelming.
The longer they kept the doors open, the more they were losing, because people were just liquidating their assets to get out of their failing. Well, they were not technically failing. We couldn't see it, but of course it will get there, because if everyone is withdrawing their money, then the integrity and stability of those institutions become compromised overnight. We see with Binance, within a matter of days, people withdrew over $1.14 billion. You can imagine the progressive, and I'm aware it's even gotten over $2 billion now. If that continues at this trend.
Now they have deep pockets.
Yes.
They are well capitalized. But even I think the point is, even they can die a death of many cuts.
Yes. No matter how stabilized you think you are, if the investor confidence is gone, if there's massive depositors panic, how do you stay afloat? Liquidity is very critical to their stability. So no matter how much you go into that deep pocket to keep funneling money to stay liquid, there are people that are massively liquidating their assets. So it's just like putting, an African, you're putting your water into a basket. It just keeps draining that way. So until we are able to plug that leak through building,
good proverb.
Yes, investor confidence. And one of the ways to do it is through a globalized approach to make sure that consumers know there is a very stringent and effective structural regulatory approach to the key providers. So even in instances of financial distress and disruptions, they understand that, like we have with the central bank mandates in traditional financial systems, there is a framework for their protection. Because the crypto protection in the normal bankruptcy proceedings we see is not what it is.
Thing is, globalization,
yes.
Common rules, harmonized rules. And when things go wrong, there needs to be enforcement.
Yes.
Malfeasance needs to be taken to task. But that enforcement will necessarily be on the local level.
Yes.
Different jurisdictions have different levels of enforcement resources.
Yes.
That's still a gap in the system.
Yes. A gap in implementation can be easily solved if there is an harmonized approach in the regulatory front. Because then there is a template through knowledge sharing and peer learning on how to apply to similar circumstances. Of course, you will know that what we have in the very developed economies might not be necessarily applicable in the lesser economies where financial development and technology development is not as advanced as the other counterparts. But there's opportunity for learning through this approach. When there are opportunities during these policy levels, high-level policy implementations in the advanced economy or the mid EMDEs, they can trade on the taxonomies that they're seeing applicable within their respective jurisdictions. So even where there are issues of gaps, there's always going to be gaps. the important thing is how do we make sure that we manage it without exposing much of our economy to the risks, and the consumers are protected too.
See, I mean, about a decade ago, I would have said, okay, we're living in a world that's regulated from London and New York,
Yes.
largely. I'm not sure that necessarily holds to the same degree. I mean, it's still true to a large extent, but to the same degree, probably not. You're talking about harmonized rules to make the system in this field work better.
Yes.
But I can tell, I mean, for a number of things, the Europeans are like, no, for us to accede to globalized, harmonized rules undermines consumer protection. We want to give the investors even more protection than they tend to get, maybe, say, in the common law world. So, that there is that. But I want to come, in the time we've got left, to your point about for intermediation and decentralization, people accept the idea that more adjusted regulation will give more legitimacy and more opportunities for traditional financial customers who want to explore crypto. Be more reassuring. Now, how far they want international regulatory organizations, supervisory bodies in crypto systems is the question. I mean, I think the subtext to that is, to what extent do nation states want to give up authority?
Yes, the fundamental framework, the fundamental ideology that the crypto ecosystem was built upon is the idea of deregulation or no regulations. That is a niche economy that prevents all the cost implications and the bottlenecks that comes with excessive regulations that we see in traditional financial systems. But increasingly, we find that there are systemic risks arising from operational risk, governance, and mismanagement. So even the consumers that are involved in the niche environment, they're not aliens. They appreciate the security that come from the institutional frameworks of regulations. But there are still proponents that are of the view that there should be no regulations within the crypto ecosystem. How do we balance this group?
Yeah, that they're not aliens.
Yes.
They're citizens of particular countries.
Yes.
That shapes their views on, what their rights are.
Yes.
The level of consumer protection they expect.
Yes.
What they expect the government to do if something bad happens. And so, you're coming up against those expectations. But yeah, I mean, I do see it comes down to, again, to what extent are national governments willing to cede, to yield to supranational bodies. But in the time we've got left, is there anything else you want to add that you feel we haven't covered?
Oh, well, I think the only thing that I would like to add is that the insulated approach to crypto ecosystem, I think at this time it's profitable, but long term, I do not see it providing as much effectiveness as we would expect. So I think one of the things I would suggest is that the regulators increasingly consider the idea of broadening their perimeters to include crypto ecosystems.
Okay.
That way we'll ensure that we have better consumer protections as well as limiting all prospects of financial stability risks arising from the niche environments too. Yes.
Well, Siju, thank you again for joining us.
Thank you so much, Ajay. It's been an absolute pleasure.
And to our viewers, thank you. Until next time.